Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at MP Materials.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Great. I think for a long time, people saw MP Materials as, well, just a mining company, right?
Exactly. A pretty straightforward operation. They were producing rare earth concentrate from their Mountain Pass mine in California. Simple.
But that's not really the story anymore, is it?
No, not at all. To really get what's happening today, you have to see this massive strategic transformation that's underway.
Okay.
What we're looking at now isn't a typical miner. It's a company that is building piece by very complex piece a fully integrated supply chain.
And that distinction is it's absolutely essential, isn't it, for anyone looking at this as a long-term investment?
It's everything. The core mission has completely shifted. It's no longer about, just digging raw material out of the ground.
It's about controlling the whole process.
The entire process,
Yeah.
from the ground up all the way to the final product, the magnet. The whole idea is to become the only integrated mine-to-magnet manufacturer outside of China.
Now that is how you build what people call a strategic moat in this day and age.
It is.
Yeah.
And that moat, it's really anchored by the physical asset itself. Mountain Pass is, it's one of the world's largest known rare earth ore bodies.
And it's high quality, which is crucial.
So crucial. That resource security is the first big competitive advantage.
Yeah.
You simply can't execute this kind of multi-billion-dollar strategy unless you have that guaranteed high-volume feedstock. It's the security Western economies have been missing for decades.
So if we think of the mining as stage one, the real game changer is all this downstream integration. They're moving beyond concentrate, which is like the lowest value part of this, into separation and refining. So what are the key stages here that investors really need to be tracking?
Okay, so the transition really involves two major, very complex phases. Phase two is all about separating and refining what are called light rare earths.
Right.
Primarily NdPr oxide.
NdPr, that's neodymium and praseodymium.
You got it. And that's the core material you need for these high-power permanent magnets that go into, well, everything from EVs to very sophisticated defense systems.
Uh-huh.
And they're already scaling that up.
But the really strategic part, the piece that connects directly to, geopolitical independence, that involves the heavy rare earths.
Precisely. And that brings us to stage three, the heavy rare earth refining circuit.
And that's still on the horizon.
It is. It's scheduled to launch around 2026.
Okay.
This is incredibly challenging chemical processing. But if they succeed,
Not pull it off.
MP Materials will become the only significant non-Chinese source for these highly critical heavy rare earths. These are vital for things like advanced military applications and the most premium EV motors. That vertical integration is what elevates them from just a commodity play to a piece of, well, irreplaceable national infrastructure.
And that kind of operational complexity, this huge build-out that inevitably brings us to the money, to the financials.
Of course.
And this is where the current numbers can look a little confusing if you don't grasp the strategy behind them. We're talking about a company that is actively sacrificing short-term revenue for massive long-term growth.
Yeah, and that creates a really challenging financial picture for anyone just looking at the last quarterly report.
Yeah.
For instance, Q3 2025 revenue was around $32 million.
Which was a noticeable drop year over year. So that the immediate question from the market is just, why? Why is revenue falling when production is supposed to be ramping up?
And the simple answer is it was intentional.
They weren't making less, they were just selling less.
Exactly right. The company made a strategic choice to shift volumes away from its old, low-value business model, which was selling raw concentrate to China. And instead, they're now holding that material. They're either stockpiling it or diverting it to their own internal high-value refining process. Selling concentrate gives you cash now, but this builds future high-margin products. It's a cash flow pause, but it's a strategic one.
So how do we know this is actually working? Where should listeners look for proof that the engine is really running and scaling up?
The proof is in the production volumes of the refined product. You look at the Q2 2025 results, and you see sales nearly doubled to about 57 million. So the capacity is there.
Right.
But more importantly, their core NdPr oxide production volumes surged by a massive 119% year over year in that quarter. That tells you the production engine is healthy, it's scaling dramatically, and they're moving material through phase two successfully.
Even while the magnet facility is still being built.
Yes, even while that's ramping up.
So what we're looking at is a high valuation today with negative earnings, but that valuation is justified by what you might call an earnings power inflection down the road. You're buying the potential, not the present.
That's a perfect way to put it. The long-term context is absolutely critical here. Analyst consensus forecasts are, well, they're explosive. They paint a picture of dramatic, almost vertical growth.
What are we talking about numbers-wise?
Revenue is projected to climb from roughly $204 million in 2024, which is sort of the bottom of this strategic shift, to a staggering $1.42 billion by 2029.
Wow. And that's the moment the financial switch really flips then. The earnings per share, the EPS, swings from a loss in 2024 of around what? Negative 44 cents?
Around there, yes, all the way up to a significant profit of plus $2.37 by 2029.
That's the power of vertical integration right there. You go from selling raw dirt to selling high-tech finished magnets.
And this huge transformation, of course, needs huge capital. The CapEx, the capital expenditure, is on a massive scale to build these facilities. But the good news is they're well equipped. They have a really strong balance sheet. Total assets around $3.8 billion.
And having that strong balance sheet, that cash reserve, is key. It means they can fund projects like the big Fort Worth magnet facility without taking on a ton of debt or diluting shareholders right now.
Yeah, they've strategically minimized their reliance on the open market during this whole construction phase.
And that financial stability, it just sets the stage perfectly for the next pillar of their strategy, which is the sheer gravity of their partnerships.
This is arguably the strongest piece of their moat. We're talking about government and commercial entities that are actively de-risking the company's future demand.
Let's start with the government. When you look at the Department of Defense's involvement, this isn't just an investment. It's a strategic alliance. It completely changes the risk calculation.
It does. The DoD, the U.S. government, now holds about a 15% stake after a $400 million preferred equity investment. This is pretty much unprecedented backing for a raw materials company in the U.S.
So what does that backing actually do for an investor?
It's a dual benefit. You get the capital injection, and you get a demand guarantee. Critically, the government guaranteed the offtake of 100% of the Mountain Pass output that feeds into the new magnet facility.
That visibility into future demand is incredibly powerful.
It is. But the real insurance policy, the true de-risking element, is the price floor they established.
Right.
The DoD set a price floor of $110 per kilogram for NdPr. What this means for you as an investor is just downside protection. Rare earth markets are notoriously volatile.
So if global prices crash for whatever reason,
MP Materials still has a guaranteed minimum price for its most important output. It mitigates that primary commodity risk.
and then beyond the government, they have massive commercial validation. They're not just selling an idea, they're selling a real solution to blue-chip partners who need to get out of Chinese supply chains.
Yes, exactly. You look at the long-term magnet and recycling agreement with Apple, a company famous for its tough supply chain standards. That's a $500 million commitment.
Which validates their tech, their environmental standards, everything.
It's not a pilot program, it's major commercial integration. And then equally critical is their tie-in with the U.S. auto sector.
The General Motors deal.
Yep, locking in 1,000 tons of annual magnet supply. That ties them directly into the U.S. electric vehicle transition. These partnerships are so important because they absorb the massive future capacity that Fort Worth is being built for.
Without guaranteed buyers, the whole thing is just a big speculative bet.
Exactly. With them, it becomes a calculated risk.
And the company isn't just thinking domestically, are they? They're projecting this U.S. tech expertise onto the global stage.
That's right. The joint venture with the Saudi Arabian mining company, Ma'aden, for a rare earth refinery, that adds significant global optionality. It extends the Western-aligned supply chain into the Middle East. It shows they can be a global technology provider, not just a miner in California.
And all of these different threads, the government deals, the commercial partners, they're all converging on one immediate critical milestone. If you're watching this stock, you have to be tracking the commissioning of the Fort Worth Independence Magnet Facility.
That is the pivotal trigger. It's expected by late 2025. This facility is the final stage. It's what turns the refined NdPr into the actual finished magnets.
And once that's online...
Once it's officially online and ramping up, it unlocks the direct, high-margin sales to GM, to the defense sector, and instantly shifts the entire company's revenue profile. That facility defines the timing of the earnings inflection.
Okay, let's shift gears a bit to recent market activity. The Q3 2025 results came out in early November. Given the negative profit, what did the market take away from that?
Well, while the profit was negative, for those strategic reasons we discussed, the market really focused on the operational confirmation. Continued record NdPr production.
For showed the plan was on track.
It confirmed the execution was on track. It was a vote of confidence that the core engine was performing as it should.
Now, we did see some notable insider activity in November. The CEO and CFO sold some sizable blocks of shares. When the strategic news is so bullish, how should we read that?
That's a crucial point. It's important to see when it happened. This selling occurred after a truly massive stock run in 2025. The stock had appreciated dramatically.
So this is personal portfolio management, not a lack of confidence in the company.
I think that's the right way to see it. It's executives diversifying their personal wealth after a huge, successful run. It's pretty standard. They still retain very, very large stakes in the company.
And that retained holding is the real signal.
That's the signal of their long-term alignment. If they were selling everything, that would be a red flag. This is just prudent management.
Makes sense. So looking ahead, say, the next 3 months, what are the key catalysts that could drive some real volatility and attention here?
We've got a few crucial dates. First, the Q4 2025 earnings release. We expect that in early February 2026.
And management commentary there will be everything.
Investors will be hanging on every word about the DoD funding execution and, most importantly, the progress and initial ramp-up capacity of that Fort Worth facility.
And beyond the earnings calendar, what about institutional flows?
Absolutely. Institutional 13F filings will come out in January. That's when we see which large investment managers bought in last quarter. Plus, you have ETF rebalancing events in December and January. Given the stock's importance and price movement, these events could drive significant short-term liquidity and ownership changes.
Okay, now let's talk about the rumors. The high-impact speculation that, if it pans out, could really move the stock. We are hearing consistent chatter about talks with other major U.S. EV producers, maybe Tesla, for magnet supply.
Yes, that chatter is definitely out there, along with speculation about expedited magnet procurement from the DoD, which could pull revenue guidance forward.
And we have to be clear, this is unconfirmed.
Absolutely. Treat it as speculation, but it underscores the explosive upside potential here. If they lock in another massive EV contract on the scale of GM, or even bigger, that earnings forecast could get much steeper, much faster.
All right, let's pivot to the risks. With any high-growth, high-capex story, we have to look squarely at the risk factors. What is the single most important one here?
It is pure execution risk.
The actual building of the thing.
Yes. Building a fully integrated supply chain, especially a complex magnet facility, and even more so, that heavy rare earth chemical circuit. It's incredibly challenging. These aren't standard factories. This is specialized chemical engineering, much of which was, outsourced from the West decades ago.
So the risk isn't capital or demand, it's the difficulty of bringing this complex tech back to scale quickly.
Precisely. Delays in scaling these facilities could easily push back that 2026 EPS inflection point. That would severely test investor patience and could trigger downward revisions. It's a race to convert CapEx into revenue.
And then there's valuation risk. We've talked about future revenue, but based on today's revenue, which is intentionally low, the stock trades at a very high price-to-sales multiple.
It does. And that's the classic risk for a business like this. The multiple looks high because the denominator current revenue is low.
But the guaranteed offtake deals help mitigate that.
They do. The market isn't pricing the company on a $30 million quarter. It's pricing it on the projected $1.4 billion in 2029 revenue. You have to buy into that long-term view to justify the entry point today.
So if we connect all of this back to the broader picture, the technical outlook seems to really support the bullish narrative.
It remains very strong. Despite the day-to-day volatility, the stock has shown sustained bullish momentum all through 2025. It's consistently trading above its key technical benchmarks, the 50-day and 200-day moving averages.
And analyst sentiment has followed suit.
It swung hard to the positive side. You're seeing high price targets reaching up to $112, which reflects real confidence that this integrated platform will eventually deliver on its profit potential.
So it seems the defining challenge for MP Materials is a really powerful one to think about. They are balancing strategic security against pure profit maximization. Will the contracts and the price floors that were required to secure domestic supply, like the DoD's offtake, will they ultimately limit the company's maximum profitability if global rare earth prices were to spike significantly higher? It's a fascinating trade-off.
It is. Security versus pure commodity upside. That trade-off is what you, as the investor, have to constantly monitor.
If you found this discussion useful, be sure to subscribe to Smart Wealth with Joshua for more daily stock analysis.